Welcome everyone to season 2 of 4200%. I'm your host, Anthony Geraci, founder and CEO of Geraci LLP. We're going to talk about how to build, scale, and sell like we did season 1. And how do you build and scale? You won't want to miss the tips and tricks they bring you. This is Anthony Geraci. I'm excited to see you in season 2. Welcome to another episode of 4200%. I'm excited to bring you the co-founder of MCM and the co-founder of Templeview Capital, Steve Trowern. Welcome to the show.
Thank you for having me. I'm honored to be here and looking forward to how we can enlighten your listeners.
I'm excited. So as we talked about, right, this is all about 4200%, build, scale, and sell. And the theory behind it is, of course, entrepreneurs who build companies hard, there's probably something wrong with all of us who want to build companies, but then to build it at scale is just a whole different level. And I know you've done quite a few companies at scale. What's been your experience in scaling companies and your thought process?
Well, so everything that I've kind of done, my early career was in investment banking. So I was a telecom investment banker, primarily for Lehman Brothers for like most of the 90s, if I'm dating myself and being honest. I left banking in 2000 to start a company that really was kind of 20 years ahead of its time, or at least 10 years ahead of its time. And I started with a couple of friends of mine from growing up and from college. And the idea was to be like the Dell computer of consumer electronics, create your own devices. Mm-hmm. We'd had kind of a Napster, if you remember that name from many years ago. Kind of a Napster angle where we could share music and store music and put it across different devices. And we needed to raise about $50 million, and we raised $25 million before the dot-com bubble in March of 2000 kind of struck landing. Mm-hmm. And that company, some kernels from that company, including my partner, Tony Fidel, went on... he took an idea that was kind of on the wall and he'd been working on, and it was a white MP3 player that had little earbuds, and he knew Steve Jobs from his prior life, and developed the iPod.
No kidding.
So some of the engineers, I was not part of it. I had nothing to do with the idea. But he took that and built, really essentially created the modern smartphone era, right? Because that all led to the iPhone and all the features that we use on a daily basis, and we're all addicted to the device that's in our pocket. And but I really got kind of a taste of like being an entrepreneur and not just working for a large corporation. Mm-hmm. And so I looked around for opportunities of what to do next. And I partnered with a couple folks in Boston who were looking to create a mortgage lending business, and really kind of start as more like a broker business that we can kind of grow. And the more I looked into it and I built a model and I studied the regulations, I thought, well, this is a pretty cool business. Like if it's done right, you can be pretty successful. It doesn't need to be a cutting edge technology. It can be an old fashioned industry that if you do a better job than your peers, it can be pretty financially rewarding and pretty, rewarding in general just to create something from scratch. And so from 2002 to 2009, we built this company called Dynamic Capital Mortgage. And it was, it was a really great company. It's a fast growing company. We focused on a very, kind of high quality borrower. We didn't do any subprime lending. When people hear that I worked at Lehman Brothers, they assume that I worked in real estate and that I caused the crash. I did not. I had nothing to do with that at all. But that business became very difficult over time because as you got into the sort of 2007, 2008 era, you the personal risk that we were taking, guaranteeing warehouse lines, the volatility, the uncertainty with the mortgage market became a very difficult business to kind of manage the risk. Mm-hmm. And we had about 100 employees at the time, and I started to think like, well, if this business doesn't survive, where's the opportunity next, right? This is the same thing, the same kind of theme in my life as I'm looking for, like, what's the trade that's on the horizon that no one has really thought about or put to work yet. And that led to the creation of MCM Capital, which I started with a partner in 2007. And we originally were looking at performing whole residential loans that were at risk. They were at they were on their way to a security or securitization, landing spot, and that market began to seize up, and so those assets had nowhere to go. And we originally started buying loans initially with sort of friends and family money, and then as the opportunity grew, we raised some institutional capital, and we were buying loans and using debt forgiveness as a means to right-size the loan and properly underwrite it according to agency or jumbo guidelines. And what happened over the course of the next year or two, because this is all made up, it was entirely new, nobody knew anything about it, it was sort of the Wild West, is those borrowers either continued to perform or they became delinquent.
Yep.
And the vast majority did not continue to perform. So we shifted and pivoted the business, which was a very difficult thing to do at the time, into buying non-performing loans. And so MCM Capital, since 2008, and it exists today, we've been buying and been an asset manager for large institutions and some banks, some hedge funds, really is kind of a sub-manager, and trying to go from buying 10 loans at a time. I think the first trade we did maybe had 50 loans in them. And the next tape we got, which was from Lehman Brothers, ironically, I think had 1,500. And so suddenly and it's all in Excel, right? We had no systems, there was no rules.
Right.
And it was really, it was an interesting time because we were flying by the seat of our pants and we were making it up as we go. But you had to line up the capital to make this opportunity work. And we all thought, well, this is a 6-month opportunity. It's a savings and loan trade again. We'll buy some loans. The world will correct itself, and we'll go back to what we were doing before. Well, as it turns out, it's 2026. That business still exists. And over the course of the last 17 years or so, well, I guess now getting closer to 20. I don't want to admit that, but when I do the math, it's closer to 20. We bought over $10 billion worth of loans. We bought, I think it's about 33 or 34,000 individual units. And in order to buy 34,000 loans, you've got to underwrite and bid on $500,000. So it was an incredible scale. We built databases from scratch on a pretty shoestring budget. We hired a lot of people. We realized very quickly that we needed to have a robust servicing operation, and we didn't want to outsource that. So we essentially built a servicing business within the company, and we went from 7 or 8 employees in 2008 to 135, I think, at our peak. But really, what was interesting to me, and looking back on it, at the time, it was you don't really fully appreciate these things when they're happening. But when with hindsight, you can look back. It was exciting because it was completely made up. It was not we didn't have a product to sell. We didn't have a technology to sell. We weren't curing cancer or solving, global problems. It was simply a trade that we had to institutionalize ourselves very quickly and get to scale. And so to your point, how you do that is really difficult, but picking the right kind of senior team was crucial to that effort. And I can say that from the senior folks who are with us or who started with us in 2008, I think all of them, with the exception of 1 or 2, still work with us today. So it's been a really longevity. So having a team you can depend on, having a team that is a family, first and foremost, was a really critical component to having some success in that space. In 2016, we had sort of finished a mandate with a large credit fund and I'm not going to name names for different reasons, but we worked for a large credit fund, and we were kind of tired of being, Mr. Spock. We wanted to be Captain Kirk, right? We wanted to be in the chair. Yep. And so we went out and we raised our own capital, and that business continues today. And we still have a fund that buys some performing assets, buys some new origination, and buys non-performing loans. But along the way, we were getting a lot of phone calls because when you're buying non-performing loans, a lot of these loans turn into houses. Yep. Some go foreclosure. We try to avoid that. We were very successful at modifying a lot of homeowners, keeping them in their house. We were very flexible because the ultimate outcome is you really don't want to foreclose. It's the worst outcome certainly for the homeowner, and then often for the capital, is to foreclose and take the asset yourself. But it does happen. And we were getting a lot of inbound calls from real estate investors who were buying properties out of our MPL fund. And they were looking for seller financing, right? They wanted to buy not one house, they wanted to buy 30. Right. And they wanted to renovate them, and they wanted to add value and refresh the housing stock or refresh the collateral and then resell the property. And so we looked at that and thought, once again, there's an opportunity. Like, why don't we just make something up and do this? So we like to think of it as, when we talk about those days, we kind of built the company backwards. We started with the opportunity. We raised money. And I think this is probably the critical, the most critical success factor when you're in a financial trade is having access to capital. And we've been very good at raising money. We've been very good at being stewards of our investors' capital. And but we didn't start it like a mortgage company. And to back up a little bit, Templeview Capital is a business purpose lender. So Templeview Capital lends money to investors who buy houses to flip them, who want to build new houses, who need some bridge financing, or who own rental portfolios or rental properties they want to finance on a long-term basis. And we were essentially meeting like a reverse inquiry. They wanted seller financing, they wanted rehab financing. And so we raised capital and we built a company. And once you build a company, you have to have the institutional reporting and controls and having the right, kind of vendors around you and the right systems. And so we spent a lot of time and effort and money on developing that. And then we built our operations, and then we finally got to our salespeople. Like, it's the exact opposite how most people build a mortgage originator. You start with some salespeople, and you backfill with some underwriters, and then you hire some, finally you hire some accountants to actually, keep track of all the numbers. Well, we did it the other way around. And I think, it was a blessing and a curse. It was a blessing because we were institutional grade the day we opened. And I think our first loan we closed in January of 2017. But at the same time, to scale, you have to develop relationships. Like, this is one of the last, I shouldn't say the last, but it is one of the few remaining sectors in the economy really the world, where human relationships, physical human relationships, really matter. Like, markets go up and down, rate cycles happen, opportunities come and go, regulations change, but relationships don't. And those are really what the long-term asset value of origination platform is your relationships. And this business, in fix and flip lending, ground up construction, investor financing, it's all about relationship. Can you deliver on what you said you do? And when you deliver, can you continue to provide service to that person so they come back to you? And we've been really successful doing that. I think as of the end of 2025, our book is of what we kind of currently own is over $1 billion. It's become it's become really the growth driver of the franchise, of the platform. And 82% of our book is represented by repeat borrowers. So I think we're doing something right.
Absolutely.
But it goes back to hiring good people. People understand how to build and how to maintain relationships, because that's all these things are like. That's what it is. If we took this business and sold it, and we're still kind of one of the last independent fix and flip or RTL originators out there. The value is in the customer list. Like, there's value in the book, but the real value is in the customer list. How can you continue to deliver financing needs to the investor community?
Absolutely. Great answers, great responses. We hear a lot about people on the show, which of course is very important, and most people know that. But I really like what you said, because it's funny. You did build it opposite, because most people do focus on the sales first, and then backfill it. I mean, I could tell you some of the guests. It's like you still build that servicing company because it's all about control and that customer service aspect of it. But that's kind of the last thing they build instead of one of the first things they build. So I love that. One thing that I think you made me think about, because you're like, we're figuring out what I call building your wings on the way down, right? And I heard that, and I hear that from a lot of founders.
Can I steal that?
Please, yeah, right. Please, absolutely, it's all yours. You build it on your wing.
We have it on record. I've got permission
absolutely
to steal.
Can. And I feel the same way, right? Growing my companies, it's always jump first, build as you go. That takes a certain mindset that I don't think we talk a lot about.
Yeah.
Can you talk about kind of the mindset you had? Because it's not just enough of, hey, I show up, someday. It's not just, I think I'll jump today.
Yeah.
How do you build that mindset of the toughness?
You sound like Mrs. Trowern. You have to have a tolerance for risk. Because when you are out raising money, and to be honest, if you're going to do anything in this sector in any kind of scale, it requires institutional level money. Mm-hmm. And that requires controls and systems and reporting. But it also, you are taking real risk. You are stewards of real capital. Yep. Hundreds of millions or billions of dollars, depending on how big your business is or your platform. And you've got to think of that as every one of those dollars is your own. Mm-hmm. And you have to be comfortable when things don't go well. And this business, the housing market in general, mm-hmm. seems to be hit by a 100-year storm like every 3 years. Yep. So as we went through COVID was difficult for everybody. We were very proud. We didn't lay a single person off. We honored every term sheet we had out there. We didn't stop lending. Some of our peers did for lots of reasons, right? Usually because the capital required them essentially to take a pause. Yep. But we kept going. And at the same time, you come out of COVID, and then you have the Federal Reserve raise, the overnight rate by 550 basis points in the course of, a year and a half. Yep. And when you have a book of fixed rate mortgages and you have a lot of floating rate debt and the securitization market is essentially closed for a period of time, that's a very difficult period to operate in. And so discipline, and so a couple things come to mind. First is discipline. Like, stick to what you know, stick to what you're good at, and stick to the rules that you've set. Because a lot of people, when they get into those environments, will take chances that they shouldn't take. Mm-hmm. And you have to be disciplined. And then you have to have a team around you of people that you can trust and people that believe in you who are going to stick around. Because there's no way we would have gotten through that period if we had a mass exodus of our team. And that didn't happen because they believed that we were going to weather the storm together. So the combination of what I talked about earlier, relationships with borrowers mm-hmm. and customers. So not just the end borrower, but we have some third-party originators who are close partners of ours, and treating them well, honoring your word, not pulling the rug out from underneath them because they're in a similar position to you, right? If things don't go well, they could be out of business the next day. Mm-hmm. I tell a story about one of our early clients who now has outgrown us and gone off and spread their own wings, to use kind of paraphrase your earlier analogy. They were a day from going out of business. They told us. They went home. Two of them talked to their wives and said, "We're closing shop tomorrow," and we fulfilled our commitment. And that bought them another week, and the week bought them a month, and the month bought them a year, and they've gone on to great success. And if they watch this or see this, I think they'll know who I'm talking about. But you really have to have, you have to be willing to tolerate risk in a way that doesn't affect how you operate your business. And that sounds obvious and simple. Mm-hmm. But when you're faced with essentially, guns pointing at from all directions, relying on on the confidence that you're going to make through this thing if you continue to do what you do well. And that's what we did. And so as we kind of emerged from COVID and post-COVID inflation and rising interest rate environment, we took a hard look at how we wanted to position ourselves. We spent a lot of time upgrading the experience of our customer base. Mm-hmm. We spent a lot of time thinking about what markets we want to be in, what markets we didn't want to be in. That's hard to kind of pull off, in general and to actually execute on. And it took about 2 years to where we got to the point where we are now, essentially now with all cylinders firing. Yeah. And it was not a pleasant time, as my wife will remind me. So
Not at all. And something you said is powerful. You know, I want to emphasize on that too. You know, you were disciplined, but you fulfilled contracts where you may have been uncertain of the next step with the future, you know,
Yeah.
as COVID goes on, where other people would have paused those contracts. They would not have fulfilled it. And you did.
Yeah.
And I wonder that attitude, coupled with, as you said, relationships are everything, have made the relationships so that all your companies are going to grow. As a result, people have that confidence you're going to do what called the right thing, right, at the time, and able to do so.
Yeah. Believe me, there were moments when we were thinking, should we follow what other people are doing? There were some large players, some of the early pioneers in this business, who stopped lending, and and there were smaller players in the sector who relied on them for capital. Essentially, if you're selling loans to somebody, that's a form of capital. If you're raising money as equity, that's a form of capital. Well, to kind of remove that capital overnight for companies that are not always well capitalized, it's a death sentence.
Yeah.
And so when we talked about before, the relationship part is the critical success factor. Yeah. And while there's contracts in place and there are protocols and there's sort of norms, nothing has to be enforced, right? We could have easily turned everything off and paused and probably been better off for it in the short term. But in the long term, you're making a handshake with your customer. And if you're not going to be willing to honor that handshake, then you don't have any long-term value, we think. Like that's been our philosophy since the beginning. It has paid off, I will say. So in hindsight, again, it was the right thing to do. And by the way, if it happens again, I think we wouldn't change a thing. Like we would still continue to honor our word and not leave anybody in the lurch, because we've been in that position too. Like maybe our capital is a different form of capital, and our capital was very loyal to us. Our banks were very loyal to us. I will name a couple. I'll say that Goldman Sachs and Deutsche Bank were incredibly loyal to us. Back in California was very loyal to us. So I'm naming some names for your show. And Forbright Bank, they were there. Our capital was there, and that allowed us to at least continue to breathe and honor our commitments to our customers.
Yeah, no, but I bet they saw also your integrity in honoring those contracts, knowing then when things get difficult, you're going to be there for them, pay for them back as well. So it goes two ways, I bet.
Yeah, one would hope.
Yeah, I love it. I think back on the law firm as well. We didn't lay anybody off during COVID. And as you know, and maybe people have forgotten already, this is way before the forgiveness loans came out. You had no idea. Yeah. Do you lay people off? Do you not? PPP is not a thing right now. And as the entire mortgage industry we lost $200,000 a month. I've shared that story with people quite a lot. And still kind of to your point is, well, we're going to keep people employed. We're going to keep them busy. You're going to show up 40 hours, we'll work on processes, we'll work on different things. And that allowed us, so for us in the law firm, we did a lot of marketing during COVID.
Yeah.
And we were one of the thought leaders of the space. And that, I think, helped us gain market share, kind of doing the same thing, which is, well, if we're going to do it, let's lead and market share, not just to gain market share, but also provide value to people.
Well, and that's why we're here today, right? Because you looked around and you said, well, hold on, we're pretty good at this marketing thing. Mm-hmm. Like we should have conferences, we should do a lot more stuff, and it's worked. And you've done a tremendous job, I think, for essentially seeing an opportunity that is a little bit unclear. Like it's one thing to look at, if there's a bunch of tariffs announced and, maybe those you think those are going to get walked back, and you wait for kind of stocks to sell off and you wait for your time to buy. Like It's a fairly easy thing to kind of get your head around and make a bet that these things will recover relatively quickly. When you're kind of going on a hunch or like a gut feeling that maybe marketing is the kind of a thing we should have as a real business, or we should create a new lender as a business, like all these things you don't really know. Yeah. So you got to have confidence. That's what go back to the kind of like the risk makeup. When you're younger, it's pretty easy to take risks. Right. You're in your 20s, like you should take risks. Like that's the time you should be taking a lot of risks. It gets harder as you get older and farther into your career. But then you got to look around and say, well, what are the things that we have going for us? And it's the people, it's relationships, it's the things you build over the years, it's the expertise, It's the knowledge, the installed knowledge of the company, and look at that and say, if I'm an outside observer and I saw those characteristics in a platform, would I bet on them?
Yeah.
And we looked at it and said yes, and we bet on ourselves. So
Absolutely.
it worked out.
I love that. What's next for you in Templeview, MCM, or maybe other companies?
We're continuing to grow, so we're not done growing. We have some pretty lofty goals for the next 2 or 3 years. Like, this is a pretty interesting time to be in this business because over the last sort of two kind of general trends, or I'll touch on 3 trends. One is that the business itself has become much more institutionalized, right? We have there's rating agencies that will assign ratings to bonds. That opens up a whole universe of investors. We have a rated shelf. We've done, I think, 3 rated deals in the last year and a half. We just did one in January that was very well received. And so the business is getting more accepted by the general public fixed income community, right? And that's crucial because that's the fuel, right? We own a refinery, and that's the fuel that you that's the coal you throw into the oven to keep the train going. And at the same time, a lot of that capital, whether it's coming in the form of buying bonds, or it's coming in the form of buying loans, or it's coming in the form of buying platforms or investing equity in platforms in order to let them grow, that's coming from a smaller and smaller universe of large mega asset managers. 5 years ago, there were a lot of credit funds and asset managers who might have had $20 to $50 billion under management, and that has shrunk because you've seen the likes of Brookfield who've been buying smaller asset managers to become bigger. Everybody is trying to get to that point where they're BlackRock or Blackstone or Apollo, and that's where the world's going, and that's really driven by the rise of private credit as the main source of liquidity in this economy. Like, it's no longer kind of a bank financing driven economy, it's private credit. There are some investors out there who worry about that. I think it's a natural growth of essentially accumulated wealth in this country, and it has to go somewhere to find additional yield. So while that's happening and the world's becoming more institutionalized, you're also faced with this problem we've had for the last 40 or 50 years, which is we don't have enough housing units in this country to house people.
Right.
And it's not just second homes or luxury homes, but workforce housing across the country. Like, we have a shortage of housing in this country, and that has maintained home prices. A negative, from a negative perspective, I suppose, it's created an affordability issue for a lot of Americans. Mortgage rates are, down now below 6% for the first time in 4 years. The 10-year Treasury is, hovering around 4%. Like, those are kind of good, for the sector. But what the RTL business is doing is helping to solve that housing shortage problem, but in a really small scale. And so we have a long way to go. Like, we could build 10 million new housing units a year and still not recover to where we need to be in terms of establishing an equilibrium between housing needs and housing demand and housing supply. So all of this sector, I think, will continue to get attention from large asset managers, institutional capital. It will continue to have demand from builders and flippers and homeowners who want to buy houses, first-time home buyers, people buying, upgrading houses, downsizing, second homes, whatever you want to say. That those two macro features are the tailwinds in this business. But you have to have the platform, the expertise, and the discipline. I keep going back to discipline. You have to have the discipline to weather all cycles.
Yep. You
got to be cycle tested, because when the tide goes out, we're going to see some people who are not wearing clothes.
Yeah, no, absolutely. I've been doing this 2 decades, you almost 3. And I say this.
Thanks a lot, by the way. You're reminding me. You're dating me already.
No, not at all. You started at 16. 46. We're the same age.
Exactly.
And it's funny because I say this. It's what's next is, to me, as funny as a decade has gone by, really, and you've seen, as you said, the institutionalization of private lending, to me, I very much believe we're still in our infancy. I think the next decade is going to revolutionize private lending even more than the past decade.
Well, I think what you probably see is you'll see some grain between traditional residential lending and residential transition lending, which is RTL. Yep. It is a from a customer experience, it's a stickier business, right? Because people who are professional builders or flippers, they need to access their lending partners, 5, 10, 30 times a year. A residential consumer might refi once every 4 years. So they buy one house and then they'll move for 20 years. And so it's a stickier business. It's still serving the same needs. It can often have a higher margin than the residential business. And I think you'll probably start to see, this is my theory, which is unproven yet, but you'll start to see some of the traditional resi people move into this space. And it's really, these businesses, by the way, are really difficult to build, like really hard to build well. Yep. And so I think you'll probably start to see some consolidation from the residential players, the big residential players coming into this sector, because it's a really increasingly important part of the housing calculus, like of the housing solution. And mortgages in general and real estate financing in general, and I'm not referring to commercial, I'm just talking about residential. It's not going anywhere. Like it's the anchor of this economy. And so there's always a position to play, but you've got to play your cards right. You got to have the capital lined up. You have to have your partners lined up, your team lined up, and you got to stay disciplined. And as I tell my kids all the time, and I learned this from someone I worked for a long time ago as a mentor, like to be really good is not that difficult, but to be excellent is it's just an additional 10%, but it's really hard to get that final 10%. It's like when you're charging, a battery on a car or something, like the last 10% takes forever. Like if you can really focus on that, on getting from really good to excellent, like that's where we're going to start to see real success stories over the coming years.
Absolutely. I couldn't agree more. And just great tips for everybody there. Ask you a couple rapid fire questions, but give you, of course, time to think about if you had to advise a small lender, maybe they want to go institutional or maybe they want to do a balance sheet. What would you advise them on how to structure their business or where to go or any advice you'd give them?
So I think I had this conversation or a similar conversation last night. There's sort of three business models. There is asset heavy, which is what we are, right? We're balance sheet lenders. We have haircut equity that we leverage through bank repo or through securitizations to create a loan. And we own those assets at the end. And that's onerous. It's hard work. It's complicated. It requires essentially constantly having to raise capital because these businesses just require capital to grow. But at the end, from an enterprise value point of view, that business is worth more. It'll command a higher multiple. If we ever sell this company, the book itself will have value. So that is a harder, longer slog, and you're going to take some risks, or you'll have bad years where you're not making, the profits aren't there that you want. On the other side of the spectrum is asset light, which is where essentially you don't have to raise any money. Not much money, and you sell those assets and you pick partners. And what I would say is if you're following that model, which can be more profitable on a yearly basis, maybe less if you're thinking about kind of the ultimate exit, but on a yearly basis, it's more profitable. But really think about picking your partners, not just who has the best price. Think about where their capital comes from. Is it insurance capital? Insurance capital can be fickle. Is it a structured takeout? We need securitization. Securitization markets can freeze. Do they have alternative sources of capital if one of them is turned off versus the other? So think about that. Pick your partners right. Don't always just take the lowest price. It's not, you're not just going to Costco. You're thinking about like value investing. Think about if you are competing solely on price, or are you competing on something that is not generally institutional in nature, and you've got kind of a, you're selling something that is unique? Consider balancing that against adding more products that are less unique. Mm-hmm. And I know that some people would say, well, that's crazy. I've got my way of doing business, but the world is institutionalizing.
Absolutely.
And if you are outside of that world, at some point, you are going to stick out, or you're going to have illiquid assets that you want to sell. So I would try to compete on relationships, on execution, and on customer service. Old-fashioned, like business 101.
Yep, absolutely. And it's funny, easy to say and hard to do. So absolutely. Any books you'd recommend they'd read?
I read a book recently by Roger Lowenstein. He's a Wall Street Journal reporter. He wrote a book called Ways and Means, which is essentially about how the Union financed itself differently than the Confederacy during the Civil War.
Yeah,
it's really interesting. It is the modern economy. It's the beginning of the modern economy. Yeah. Like there was no credit. The government didn't borrow. There was no taxation. There was no dollar. Like you essentially had banknotes as you traded. And when you look at that, the common story of why the North won is they had more industry and more manufacturing and less reliance on agriculture and enslaved labor. If you look at like that, kind of gets you part of the way, mm-hmm. but the rest of it was just control of inflation, interest rates, cost of borrowing, who had access to capital. Does that sound familiar?
Absolutely. Yeah. No, I've not read that book, but I want to. That's awesome. Amazing. Well, if they want to find out more about what you're doing at Templeview, who can they contact, or how do they find out more about you?
We have everything's on our website, templeviewcap.com. Jeff Golcher is our CMO, who fields a lot of calls from media. If it's about business development, they're always welcome to find me. I'm easy to find. I hide nothing. We're very transparent and open.
I love it.
And I would encourage everybody to reach out and talk to us.
Awesome. Well, Steve, thank you so much for joining us. I really appreciate your time and your nuggets. I learned so much, right? I talked about discipline, mindset, and then execution. And having those things, that's huge advice, I think, for a lot of business owners out there. So really appreciate you being on the show.
Great. Thanks for having me again. Appreciate it.
Well, this has been another 4200% episode. I'm your host, Anthony Geraci. Really appreciate you guys being here. We'll see you next time.